Okay, well, let's go on to the US data points.
Okay, well, no sooner have we got the FOMC out of the way than we get second quarter GDP numbers from the US, so they're due out this afternoon. The forecast here is for 2.9% annualised rate versus the prior very poor read of minus 0.2. Now, of course, the low read last time round was based, or blamed really I should say, on the West Coast port strike and a very, very cold winter. At least that's what we were told. Also, I should point out that they're rejigging the way that the numbers are calculated, and that some sort of salves will be applied this time round and again in the following quarters. So it's going to be a bit difficult to compare apples with apples. But it will nonetheless be interesting to see what the read comes in at. And then perhaps of even more interest will be the weekly jobless claims, because it was one thing that the Fed did talk about last night was the labour market, and they used the phrase some improvement to the labour market would be sufficient now for them to consider raising rates. So a forecast of 272,000 jobless claims for this week against last week's 255,000 number. That number last week was a multi-decade low for reading July. So let's see if we come anywhere near that, or whether we stay around the forecasted level of 272. If we get a lower number, then I suppose you can infer that a rate rise is nearer, and if we get a higher number, well, then it's further off. And it could be that the higher number is the better number, because that means rates are staying low for longer. We shall see.